Right after Donald Trump's unexpected win in the 2024 presidential election, new data from December started to raise some eyebrows across global financial markets. Why so many major economies are rapidly pulling back on their U.S. government debt holdings, and what that could mean for the future of global finance. Out of 20 major economies known for investing heavily in U.S. Treasury bonds, 16 decided to trim their holdings shortly after Trump's win. Some of the biggest sell-offs came from powerhouses like the United Kingdom, which slashed its holdings by a staggering $44.1 billion, Japan by $27.3 billion, and Saudi Arabia by $15.1 billion. Even countries with more modest reductions, such as China, which cut back by $9.6 billion, Switzerland by $9.7 billion, and India by $14.9 billion, made significant moves. These aren't just random numbers. They're signals from nations that have long trusted U.S. Treasuries as the safest investment available. But in this instance, caution seems to have taken over. So, what's behind this sudden pullback? The simple answer is uncertainty. Global investors and central banks began to worry about the potential economic fallout from Trump's policies. When you're managing billions in reserves, unpredictability isn't an option. You need stability, clear policies, and a sense of security. Many countries kept a close eye on trade policies, interest rates, and even diplomatic moves, all of which could dramatically shift the economic landscape. If there's any hint that upcoming policies might weaken the dollar or balloon the national debt, investors start to worry. And if enough investors start selling off U.S. debt, interest rates can rise, making it more expensive for the U.S. government to borrow money. This isn't just a concern for Washington. Higher interest rates can directly impact American families and businesses, resulting in pricier mortgage rates and more expensive loans for consumers across the nation. Now, zooming out, the implications of this trend are even more profound. For decades, the U.S. dollar has been the cornerstone of global finance, the go-to currency for trade and savings. But when major global players start pulling back from U.S. government debt, it naturally leads to questions about the dollar's long-term strength and reliability. If this sell-off continues, we could witness a slow but steady shift towards other safe haven assets. Central banks, which have traditionally stocked up on U.S. Treasuries as a kind of financial safety net, are now rethinking their strategy. They're beginning to balance their reserves with other currencies and assets to avoid putting all their eggs in one basket, a process sometimes referred to as dollarization. For instance, China has been quietly reducing its U.S. Treasury holdings over the years. By October 2024, China's holdings had dropped to $76.1 billion, the lowest level seen since 2009. This is part of a broader strategy to diversify and reduce exposure to the U.S. financial system. Similarly, Japan has been adjusting its portfolio, with its holdings reduced slightly from $1.087 trillion in November 2024 to $1.06 trillion in December. Japan's strategy is clear: stabilize the yen and reduce vulnerability. Japan's move to sell U.S. Treasuries and buy more of its own currency reflects a broader desire to maintain domestic economic stability while navigating global uncertainties. Then there's Saudi Arabia, traditionally one of the major buyers of U.S. debt due to its oil revenues. Saudi Arabia saw its holdings drop by $15.1 billion. This reduction comes as part of a larger plan to diversify its economy under its Vision 2030 initiative, which aims to reduce the country's reliance on oil and reposition its economic strategy. Even the United Kingdom isn't immune to these shifts. Facing expectations of significant tax cuts and increased government spending under Trump's policies, the UK reduced its U.S. Treasury holdings by $44.1 billion, a clear sign of market jitters and growing inflation expectations. What does all this mean for the United States? When large numbers of foreign investors sell off U.S. Treasuries, the immediate effect is an increase in interest rates. This means that not only does the U.S. government face higher borrowing costs, but the entire economy feels the pinch. American families and businesses might find themselves paying more for loans and mortgages, which can slow down economic growth over time. The Federal Reserve has even hinted at slowing down on cutting interest rates in 2025 due to mounting inflation concerns. This signals a period of tighter monetary conditions that could reverberate throughout the economy, further intensifying the ripple effects of this global shift. The push to reduce dependence on the U.S. dollar isn't limited to physical assets alone. Many countries are actively building alternative banking systems that bypass traditional Western-dominated networks like SWIFT. In response to potential U.S. sanctions, Russia developed its own system, SPFS, while China introduced CIPS for cross-border transactions. These innovations grant nations more control over their international payments and provide a cushion against U.S. financial pressure. Global alliances are also playing their part. The BRICS nations, Brazil, Russia, India, China, and South Africa, are exploring the idea of creating a new reserve currency that could rival the dollar. With ongoing discussions and negotiations, these moves reflect a broader desire among many countries to achieve greater financial autonomy. So where does this leave us? On one hand, the US dollar still remains a powerhouse, deeply entrenched in global trade and finance. On the other hand, the very foundations of its dominance are being questioned as more and more nations diversify their portfolios. We might not see an overnight switch to alternative currencies or assets, but the steady trend toward diversification is undeniable. This gradual shift is less about abandoning the dollar completely and more about creating a buffer against future uncertainties. By reducing their heavy reliance on US debt, countries are preparing for a future where geopolitical tensions, unpredictable policies, and economic shocks might otherwise leave them vulnerable. It's a long-term strategy, one that echoes past transitions in global finance, such as the decline of the British pound and the rise of the dollar after World War II. It's clear that the recent pullback on U.S. government debt by so many major economies isn't just a temporary reaction. It's part of a broader, strategic recalibration in global finance. Investors are asking tough questions about the future, questions about debt sustainability, currency stability, and the true cost of political unpredictability. The coming years will likely see further adjustments as countries continue to balance their reserves with a mix of traditional assets like gold and emerging alternatives like digital currencies. Whether this leads to a significant erosion of the dollar's global dominance or simply a more diversified financial system remains to be seen. But one thing is certain. The global financial system is at a crossroads, and the decisions made in boardrooms and central banks around the world today will shape the economic landscape of tomorrow. Do you think this shift away from U.S. Treasuries is a precursor to a broader move away from the dollar? Or is it just a temporary reaction to current political uncertainties? Drop your comments below. The overarching theme is clear. The world is becoming more cautious, more diversified, and more strategic in its approach to global finance. Countries are no longer content to rely solely on the safety of U.S. Treasuries. They're actively seeking ways to protect themselves from unpredictable political shifts and potential economic downturns. In a world where economic power is constantly shifting and geopolitical tensions are ever present, the decisions made today will have far-reaching implications. The gradual move away from U.S. government debt is not just about managing risk. It's about redefining what financial security means in a multipolar world.